Intro to the session, you've got some numbers from last year, basically that the number of deals is up a bit or down a bit, but the value overall is up some. And I just wanted to start. I think if you guys can just start to unpack some of those numbers, what happened last year in your view, and kind of what does it say about the future? Somebody want to jump in on that? I can pick people you want, but go ahead.
Thanks, Bill. So I think if you contrast the market last year, both investments and exits versus 15, I think 15 was a pretty high year. In fact, it was the highest year for private equity investments since 2007. The previous boom, and that a lot of that number was driven by large ticket VC investments. 16 actually saw a tick up of exit proceeds, still not massive, but a good growth, and that was essentially the result of the exit window in India opening, especially the public market window. So a lot of funds took the opportunity to take companies public. There was a period when the public markets were doing well, and I think that is what kind of drove the growth.
I think, I was looking at the same data that Shashank was talking about, and to me there was very little to differentiate between 2015 and 16 per se, because the numbers were basically in the same sort of ballpark. But if you contrast it to what was happening in 2010, 11, 12, where the exits were very few and far between, you've seen a lot of pickup around secondary markets, secondary sales of stakes from one fund to the other. You've seen a fair number of transactions where strategics have bought into businesses held by private equity. And obviously the last piece is IPO markets really opened up, right? So it was sort of a combination of all three. So I was looking at, and the other metric that I thought was pretty interesting is just how much capital exited during these years vis-a-vis the amount of money which got invested. And in the context of almost $15 billion getting invested in the country, you saw exits total up to about 60-65% of the money invested. That's also a pretty good number compared to what this country's seen for the last, 10 years, because that number used to hover around 25-30%. So I think in general, you'd say that the market's been open for exits. It's been a good run, and it's a combination of all the windows really opening up.
Matthew, starting your own firm, what do you see going forward? Do the trends from last year say something about what's going to happen, do you think?
I think, let me step back and maybe instead of looking forward, let me step back 3-4 years back. If you are talking to either people at headquarters of firms like us or LPs or any kind of stakeholder in India, I think one of the biggest challenge has been lack of exits. I mean, there has hardly been any money coming back, and I think, I think it's pretty obvious over the last 3-4 years, things have changed quite dramatically, right? Even speaking for Blackstone, I think we are completed, the firm has returned over $1.3 billion, so most of it over the last 2 years. And I think what has driven that is 2-3 things. One is, from a tactical point of view, some of the things that we have done, as you know, firms like us would have a clear preference for one-shot exit instead of an IPO, because IPO has its own challenges in terms of you can only sell this much, and then you have to dribble, and then you have to wait for a 1-year lockup, etc. So one of the things that we have been focused on is launching a kind of a dual process where you really go after an IPO process in a real intense way, which usually brings out all potential other options that exist, right? And I can talk about one that worked out very well for us. Actually 2 of them, and one very recently. We had a company called ITL, International Tractors, which would have been a great IPO. Company had great performance, but the IPO process flushed out one of the minority shareholders, which is a strategic, who never showed any interest through our full ownership, and even when we made the investment, did not show any interest to buy. But they eventually came in and made an offer, which may not have been as good as the IPO offer, but we got a single shot check, one shot, right? In another situation, something similar happened, but it's just not done it. But we launched a proper IPO process, and we have an offer on the table from somebody we really never expected will happen. So I think that running a dual process as a tactics is something that has worked well. And second thing that I would just add to is, as you know, with the large number of, or rather increasing number of buyouts over the past several years, I think there are more quality companies from a governance, numbers, etc., which is owned by private equity, which is actually driving a lot of the secondary deals, right? If somebody has, a quality firm has owned an asset, the interest from private equity for a secondary transaction is very, very high. And one of the trends that is being talked of but still have not played out fully is you have a minority position or a large minority position with a private equity, and to make the deal attractive, quite often promoters are proposing a controlled deal as an exit at the time of the exit of the private equity. So what started out as a minority private equity investment could potentially become a strategic exit, rather a control exit, or in the next phase. So let me stop there and
Right.
A couple of other trends that have happened is if you look at the choice of sectors that private equity has been investing in. The first flush of high growth which happened in the 2005 to 2008 era, which is where a lot of exits have not happened, was in infrastructure companies, infrastructure services company. Quite a few of them are B2B manufacturing companies, and they have struggled to exit. But if you look at the choice of private equity investments over say post 2009 onwards, you would see a very high percentage of financial services, technology, pharma, and so on. And in these sectors, you've been able to find exits. And many of, if you were to bisect, while there would be the cases of International Tractors, etc., which would be, or Alliance Tires, but a bulk of exits would also happen in these 3 or 4 sectors. So going forward, when you try to wear the same lens as to what is likely to be the exit experience, you need to see that in the last few years, where have money gone in? And my sense is many of these sectors are far more amenable to exits, both trade and IPO. So that's one dimension which I think from a future perspective holds good stead. The second is even in the IPO, while the number of investments that any of us do which have IPO as the exit path and in the portfolio have come down significantly since say 10 years back. But even then, even in the IPO market, there is a far more stable base of investors. So all the statistics kind of show that there is a lot of domestic money coming in, the SIP flows into mutual funds and so on. While even that would be volatile with markets, but my sense is that it will be a little bit more stable, and the kind of fluctuations that one saw in the IPO market where it gets completely shut and then completely opens, my sense is over time those fluctuations would come down. The third aspect is choice of sectors where we plan to take it to IPO. For example, in say 2007, one would have assumed that a 1,000 crore auto component company, we take a 15% stake and that will go IPO. But today, if you look at many of those sectors, you would not find IPO as an exit strategy. So where the companies where private equities take stakes, where IPO is the exit strategy, you would find is either differentiated, high growth. The characteristics are such that it will be attractive to the capital market. So the broad point was that the choice of companies and the choice of sectors that private equity is making today would lead to a very different exit experience in future.
We're going to, later in the session, we're going to talk a little bit more here, but later in the session, I will throw it out for questions. So think about what you want to ask and be ready when we get to that point. And I wanted to hear, Dheeraj and Shashank, I want to hear about some of your particular experiences with exits. But before that, I just wanted to real quick ask Rishi, who's got some experience with public markets. Shashank talked a little bit about the importance of that opening of the public market. how that played into the numbers in recent years? Do you see that continuing? Is that important in your?
Yeah, sure, thanks. So a couple of things I wanted to touch upon regarding this topic. One is, Sudhir briefly touched upon it, which is actually true that it looks like, the IPO market is maturing compared to many years back, because over the last 2 years, you've had the equity markets actually being sort of flat and negative in dollar terms, flat in rupee terms. But you've still seen some good high quality IPOs coming and getting a very warm reception. So things seem to be changing. It's slow, it's marginal right now, but it's in the right direction. And I think that trend is only going to continue because the domestic flows are getting stronger. The age-old story of Indian retail being very less invested in equity markets and potentially will increase, which has always been a thesis but never played out, seems to be again changing and improving marginally in the right direction finally after a long time. So those are good trends which I think will help all PE funds going forward. That was one thing. Second is very interesting because I think everyone on this panel is PE focused. I wanted to touch upon something which could be interesting for VC funds. Is that the exchanges have been taking some initiatives, and there is an SME platform, there is an ITB platform for startups also now. There were issues with the regulations and the rules regarding how you could be listed, what was required to get listed and stuff. But I think SEBI has been pretty open to suggestions, and I've seen them changing some of these things which were not very practical after getting feedback from the industry. So I think that is an interesting thing where, for example, the NSE ITP platform, has 6,000 to 9,000, something in that range, crores kind of market cap already. Very few companies listed, of course, but the interesting thing is that, with just 1 year of audited financials, a startup could get listed on that, and it's very easy listing. It's not like an IPO. So I think that is something which the industry could look at, and it could really help on the VC side over time. That is the second thing I wanted to highlight. Third is about the, I'm involved in public markets and a lot of quantitative investing, but one thing, because we are US based, is we were getting impacted by the exchange rate and the Forex. And I think that is true for everybody, whether it's investors like us or PVC investors, where, at the time of entry, you don't think about the Forex because you think that, 5 years or 7 years later, we'll exit and we'll think about Forex at that point in time. But it ends up having a big impact on your IRRs. So, for example, the last 6-7 years, rupees depreciated 50%. So there's straight away that big impact on the dollar IRRs finally. So that is something we worry about, being more active and quantitative and focused on risk. And interestingly, we are seeing a lot of PVCs now starting to think about how to handle that, which I think would be healthy going forward.
Yeah, can you guys talk a little bit about some of your particular experiences in recent years with exits, both kind of what you learned from them and also what they may say going forward?
Sure. So just to, I guess, give the audience a bit of background, Apex has been in India about 10 years now. We have a focus on buyouts as well as large ticket growth deals. We've invested in 6 companies over the last 10 years and invested about $1.5 billion. So the average ticket size per transaction is about 250 million per deal. And this is split sort of roughly half between buyouts and significant minority. Now, in terms of our exit experience of this capital and these deals, we've fully exited 3 companies and have had 1 partial exit, and across, if you call it those 3.5 deals or 3.5 exits, excuse me, we've returned about $2.5 billion. So relatively, I'd say, a positive experience when it comes to exits. Now, why is this? And just again, for background, of those 3.5 exits, 2 have been on public markets. They were public companies previously, and then we we sold down our stakes once we'd sort of, if you like, made our money. One was a strategic trade, we sold the company to a strategic. And the final one, the partial exit, has been a secondary. It was to the Canadian pension plan that bought half our stake in a company. So, if you like, we've experienced all of the variety of potential exits. And I think our learnings from that are, number one, control over exits is key. We all know that exit windows are open for brief periods of time. IPO markets close and shut quickly. Strategic interest, inbound interest into India or into Indian companies is again fleeting. And so you have to be able to move quickly to be able to hit that interest or that exit window when it presents itself. So control over exit, either you control the company or you have tough enough exit rights if you're in a minority situation, or you've got liquid security you can sell. That's very, very important, number one. Number two, I think the key is, again, in our view, don't get greedy. Don't fall in love with your own company. When you've made your money, when there is liquidity and there is demand for what you have, take it. Because you never know what happens. You may not have that demand. The currency may move against you. Regulation may move against you. All sorts of unpredictable things can happen. And so hit the exit window. And then the final point I'd like to make is, I think you need to start preparing for exit almost at the time, in fact, at the same time you enter. The thinking, the planning around exit should happen at the same time that you're doing the diligence on the company, etc. Because it helps you then think through what your plan, the value creation plan, the strategic plan with the company is. If you know kind of where you're going, you know what to do in the intervening period. Number one. Number two, if you know that the most likely exit route is, for example, a sale of the company to a strategic, then alignment with other shareholders, making sure you legislate for it in a shareholders agreement, etc., all of that becomes critical.
Yeah, I'll talk a little bit about how our fund thinks about it, and it's somewhat of a contrasting style to what Shashank just described, which is we often think of ourselves as a minority investor, irrespective of the stake that we own, which also means that we recognize going into an investment that we may not have control over timing of the exit. So the fund itself structures itself in a manner that it can hold for longer periods of time, which gives us the liberty of working through an exit option. But more importantly, we try and pick assets where we want to believe that there are multiple ways we are going to be able to exit. I mean, to state the obvious, if the business is doing well, you'll find liquidity. And then it becomes a function of figuring out which path to liquidity gets you the highest price and what's the smoothest way, what works for the business, what works for your partner in the company. So, we've done 12 investments in India. 10 of those have been secondaries. We've given exits to people when we've bought into those companies. And in general, we've seen sufficient demand through our holding period for some of those assets. And I'll pick one where we've had a reasonably visible exit, which is Dr. Lal's. This company did well, and I think we took it public only because, one, all the stakeholders wanted to go public. The second being that the company was at the right stage in its life cycle, where it was more appealing to the public markets than to the private markets. And a well-governed company at 20% type growth rates, the markets are often willing to pay a higher price than the private markets do, which is not always the case, right? So we hold this view that we'll find liquidity as long as the business is doing fine, and everybody around the table understands that we are going to be patient, but we're going to try and find the right value. I'll also maybe mention a little bit about where we've invested in, because that's relevant to the topic of exits. As I said before, we've bought into most of our companies as opposed to investing capital into them. And these are great business models. They don't need capital to grow. And I think that market in India has clearly matured over the last few years, where it's not necessarily a bad trade if you're buying somebody else's stock, even if it's the founder who's taking some liquidity. But between private equity funds, what we've seen very often happening is the companies are just continuing to compound very nicely at a pace of growth which justifies private equity returns from one hand to the other. Often the same selling shareholder wants to roll their stake into a new fund. There's obviously a conflict of interest issue to be addressed. So somebody like us comes in as a third party, sets a benchmark, figures out the diligence, underwrites the new investment, and then that deal is offered to a new fund of the seller. And that sort of facilitated a bunch of trades. I mean, out of the 12 investments I've talked about, 3 of our investments happened this way. And, you know, touch wood, it's been a good journey on them.
Yeah, let me, I think most of the points have been made, but I think specifically from our experience, I think the point Sudhir made, when we look at Blackstone's first phase, I would say the first 5 or 6 years, we actually went into industries that is not attractive for, particularly for private equity buyers and to a great extent for public markets. So when you have, you know, as Sudhir directly mentioned, you know, when you have infrastructure, very highly capital intensive businesses or B2B manufacturing, the reality is that there are not too many takers, and particularly when some of these businesses are underperforming, it gets even tougher. So I think a lot of the funds in India have calibrated their investment strategy, and some have gotten it right from early on, but sticking to the 6 or 7 sectors, whether it's pharma, IT, which is less capital intensive and hence quite often results in secondary opportunities, I think that's clearly a way to play India. Second point that we, you know, we were, I think, probably in 2010 or 11 when we looked at some of the exit situations where even with good companies, we figured out that the exit technology from a legal point of view was not strong enough. So what does that mean? I think it was 2011 we said we have to have a real waterfall of options really fleshed out with specifics to ensure that the promoter doesn't have the temptation to kind of play around with you, particularly when you're in minority situations. I think having that full set of exit options and clearly laid out with great specificity actually helps exit discussion. It's kind of the alignment that Shashank talked about. Upfront, having that documented, agreed upon, makes life much easier, right? And the third point, which again I think Shashank you mentioned, which is what we do today, or rather the firm does today, your exit plan has to be from day one. And just to give you some sense, I mean, Blackstone as a firm had great focus on operational involvement. And one of the things that we did was more looking at value creation. But I think today the focus is actually value creation with a very specific focus on exit. What does it take to really build a great company that is attractive to people, to other buyers? So having that focus from day one. So I know I'm somewhat summarizing the points, but these are the common learnings that, you know, we've had at Blackstone itself.
I guess the one point that I would add, and I guess it's a learning for all of us, is very often we entered into growth situations or minority situations with a waterfall of exit mechanism. The first being generally the IPO, and then there is a trade sale and so on and so forth. And while this was negotiated with all good intentions by the entrepreneur stroke management, but the fact is that the lifespan of a private equity fund is very different from the lifespan of an entrepreneur, and that difference at various points comes into fore when discussing exit, particularly when IPO as an exit option kind of shuts down. So it is important to be pragmatic when entering into the transaction of what exactly is the exit path, is the entrepreneur, the assessment of what is the entrepreneur's intent. Is he really as intent on selling the company in a 5-year time frame as the private equity? And if that is the case, then all of what Shashank and Matthew said in terms of saying that you can put a sense of urgency into the company, do whatever is required in the first 1 or 2 years, professionalize management, do a lot of things to get the company to a stage where it can be handed over from a founding team stroke an entrepreneurial team to a new set of investors who come and take the company forward. So getting that assessment right at the beginning is something important. And my sense is, as you look at many private equity transactions of today, I think that is a learning that the industry has had, and you would find that there are clear exit paths that are pretty clear to even to the outside world as to how is this company going to exit, and that then allows you to set a series of actions once you invest.
Just to add to that, I think Sudhir, this is an important point. I think there are very few promoters who will actually sign up for a sale of a company as part of a minority private equity transaction. I think that is, even if somebody agrees to that, eventually it doesn't happen. But I think having an understanding of what the promoter actually wants to do, eventually, despite all what you document, will become important, because I can share this. In the case of International Tractors, while the promoter was definitely fully supportive of getting the company public, we knew at the heart of heart he always wanted to run a private company. So when the offer showed up from the other minority shareholder, we clearly took a call that we could have actually got an IPO done, but we knew that the clear preference from the promoter was to actually keep the company private, because he had a personal kind of a leaning towards that, and that was part of the reason why we said maybe we are leaving some money on the table. We are getting one check. At the same time, we are leaving a relationship intact where we kind of doing something that works for all the stakeholders, including the current strategic partner who is a minority, the promoter who wants to stay private and build a business and take it public probably at a later point in time. That having that calibration and kind of being respectful of that, I think, can help preserve relationship and quite often ability to quickly exit.
I just wanted to touch upon something I briefly mentioned earlier about forex hedging. So what we've seen is over 6 years that we've been doing this, we've had a meaningful impact on the savings due to the forex impact. So as you all know, over the last 6-7 years, rupees depreciated around 6.5% annualized. So obviously most people in this room don't worry about the forex hedging, or there are challenges. So obviously when you look at fully hedging via the forward market, there's a high cost to it, which is also varied between 4 to 8% at different points in time. And funnily and interestingly, over the last 6 years, that number also has come to that 6.5% annualized zone. So whether you are fully hedged or fully unhedged, you had the same impact. Therefore, meaning that, what all of us think, that it's no point to hedge because in the long run the impact is going to be similar. It's actually true. But the whole question is there some other way to plan for it, from day one, in the spirit of what the other panelists were saying, that, you could plan for the exits from the start. So what we've seen is that we use a dynamic hedging model, whereby, there is some timing associated with it, some quantitative decisions on how much of the portfolio you want to hedge on Forex, but it has a meaningful impact. So over those 6 years, we've managed to save about 3.5% annualized just from the dynamic Forex hedging that we do. And that is something we feel that while it may be a little complex for a lot of people, but in some form and shape, that can be simplified a little bit and be used by many more funds. And interestingly, as we shared this with people we knew in the industry, a lot of funds actually started showing interest in learning more about this. So that can be interesting going forward as well.
All right, thanks. So we'll ask one more question up here, and then I'll throw it out to you guys. When we do that, let's really take advantage of our illustrious panelists and keep your questions really concise and statements to a bare minimum when we do that. But give me just overview now. What are one or two things that you think could happen that could really improve the situation over the next couple of years? And what are one or two things that are really big risks on the horizon that could make the situation unexpectedly worse?
I actually think on the what could improve point, I think the circumstances are pretty good. I think the public markets are open. I think India, relative to a lot of countries around the world, looks pretty attractive, which means inbound interest is strong. There's reasonably liquid market for secondary trades. Perhaps the one thing I would pick is for foreign investors. We're a foreign investor. We often sell to foreign investors. The tax laws continue to be reasonably changeable, difficult to interpret, etc. So that can be painful for people. So I think greater clarity on the tax side would help. That would be kind of the one thing I'd have on the wish list around improving. The second, and to your second question, you know, what could upset the apple cart? Well, there's a long list, frankly. I think currency could hurt, macro could hurt. Let's see what happens with the new US administration in terms of their trade policies, immigration policies, etc. All of those could have impacts. Where US interest rates end up over the next 12 to 24 months could have a significant impact. So, you know, but that's frankly par for the course. That's what we deal with.
I think the investments that are doing well find a way of exiting, and that's kind of from a very broad macro underlying company performance, choice of investments that you make, etc. What would be a real uplift for the industry if one, to respond to your what's a wish list, what could it make things improve, is still the confidence of the industry in terms of both what Shashank mentioned, tax, and B, in terms of just enforceability of contracts. Private equity industry, like all other capital providers, rely a lot on the documents that we have signed. While all of us by now have learned that documents are one set, but you have to kind of have the relationships, the connect with the entrepreneur, but you will still have those couple of sticky investments in your portfolio where you need to know that your documents are strong enough and are enforceable. My sense is that is one area where there's still a lot of confidence building that is required. My sense probably in some ways not necessarily specific to the private equity industry, but the bankruptcy law, how that gets enforced, and all of what gives a confidence that the capital structure of a balance sheet is indeed kind of meaningful and enforceable is something that all kind of probably the entire financial services sector would look up to.
You know, the one sort of trend you see very often now is for a professional who's turned an entrepreneur in a private equity-backed business, whether they own a big chunk of it, whether it's a startup or over a period of time they've been brought in. And there are many examples one can think of where those individuals have benefited significantly by having taken that risk. I mean, I would hope to see this trend continue and grow. So I would love to see more professionals, senior business managers, willing to take a little bit of a risk, come into the industry where they are happy to work with private equity as partners. And I think that's a great ecosystem because we have a lot of entrepreneurs already, and you know, you sort of start working with a certain style of working which works in the context of financial investors as opposed to family businesses. That I would say is one positive I would look forward to.
Just add one more point. I think when you look at strategic exits, whether it is private equity or selling to strategics, one of the challenges we have faced is I think indemnities, particularly relating to taxes, and even it goes sometimes beyond that. I think there are two issues there. One is some of the Indian strategics, when they sell, they probably don't care so much about being somewhat easy on the indemnities that they provide. So the market in India is very different from market in other developed markets when it comes to to reps and indemnities. Like, if you look at a US transaction, it is pretty straightforward. You will have very basic title and very basic indemnities and reps and indemnities associated with it. But in India, it could become a little bit challenging, and with fund lives and kind of reserved cash for indemnities, which become somewhat, it's quite often becomes somewhat difficult, and that's one thing hopefully, over a period of time will change as a market practice.
All right, we're going to wrap it up here. I'm sure these guys are available on the sidelines if you want to ask a couple more questions. Thank you very much. Thanks, guys.